This is Mike Reed with CNELEC, and welcome to this week's Proprietary Research and Analysis. This week's topic is a really hot topic. It's Canada. It's Alberta's crude differentials to WTI. This has been raging for at least a month, if not prior to that. And the reason it's been raging is the differentials blew out from a historical $1,600 or $16 per barrel under WTI, which is its median since 2010. It went from 16, it blew out to as low as minus $50 under WTI. At a minus $40 level, the reason this is important, it's a $12 billion a year wealth transfer from the producers of Alberta to the shippers of the pipelines and the refiners of the Canadian crude. $12 billion a year is a huge wealth transfer. So we're going to talk about analytically what's going on with the differential, what current market announcements have happened, where it's at today, and where it's going to go in the future. The takeaways are, from an analytic perspective, production is exceeding capacity, capacity meaning capacity takeaway, whether by pipeline or by rail, of about 540,000 barrels a day. At 540,000 barrels a day of excess production over capacity explains the differentials we've observed to date. Again, the median differential has been $16 under WTI. Half the time it's been wider, half the time it's been narrower since 2010. The differential just prior to the Alberta production cut quota or mandate was $32 a barrel under WTI. The production cut of 325,000 barrels a day works out to close that differential. It's worth $10 a barrel. The second announcement is crude by rail. Alberta came out and said, look, we're going to purchase locomotives and tanker cars to the equivalent of 120,000 barrels a day. That should close the differential by about $4 a barrel. On a side note, to move 120,000 barrels a day via crude by rail, that's a $1.4 billion capital commitment by the government of Alberta. I mean, think about it. It's a huge number. The third issue is we've got a greenfield refinery starting up called Northwest Refinery. It's phase one. Is starting up at 80,000 barrels a day in Q1 of 2019. That should close the differential about $3. So the combination of all three, the mandatory production cuts, the crude by rail from the government of Alberta, and Northwest Refinery startup should narrow the differential and equilibrate it to about $15 under WTI, slightly narrower than its historical median. But that's if WTI price does not rise. If WTI crude price rises above today's $51 per barrel, you're going to require another 2 to 24% of the announced export pipelines to be built to maintain the $16 differential. If you don't build the pipelines, that differential will widen back out in a heightened crude price environment. The producers in Alberta, the 7 majors, have previously announced about 350,000 barrels a day of their own crude by rail expansion. I think that's highly unlikely to happen given the regulatory uncertainty of further mandates by the government, and quite frankly, the crude producers don't want to commit to capital or have a collateral support commitment for leasing totaling about $4 billion to do that. Let's go ahead and walk through some of the charts and tables that support this view. The first is on the left-hand side, you see a simple funnel. What's happened is the receipt point of the pipelines in Alberta, think about it as an auction. All the producers are bidding against each other to get into a very narrow pipe, and basically they have to cry uncle. So the pipe clears at the lowest producer willing to ship at that level, and the others bail. So it's an auction process that bids it down. And in all auction processes that bid it down, I want you to think about this as a non-linear relationship. It collapses immediately. It's not a steady linear relationship on G, I've got one more barrel. It's not the way it works. It's exponential collapses. On the right-hand side, when you look at what causes the differential, there's a few surprises in here. The leading cause out of that differential is what's the absolute WTI price. Because when WTI price is really high, the auction can take place and bid at a really wide differential before you breach some shut-in threshold of that producer. So high WTI, you're going to have high differentials. Low WTI, you're going to have low differentials. The second driver, explaining 31% of the differential, is system headroom. We're going to find system headroom as takeaway capacity of pipeline plus rail minus production. So when that system's got excess capacity, the differentials collapse. When it runs out of capacity, the differentials widen out. The third is currency exchange. This is a huge driver. Currencies 0.92 correlated to WTI, so those move in tandem, but this is a big driver. The fourth driver is a little bit of a surprise. Pipeline utilization levels only coming in at 1%. Well, sure, the reason for that is who's on the margin? Pipelines are not on the margin. The marginal price setting mechanism is rail. And then other factors unidentified contribute about 11%. So that's the drivers of this differential, and we're going to explore this a little bit more. If you look at these four charts, the WTI Cushing price driver in the upper left-hand corner, you can see the relationship, and each one is marked for each point in time since 2010 all the way through the first half of 2018. On the right-hand side, you see the same slope of the line because of the relationship between currency exchange and WTI Cushing. The lower left is system headroom. You can see that relationship, and then the lower right is pipeline utilization. Notice pipeline utilization is almost flat slope, indicating low relationship. If you look at the announced pipelines to date, they total about 3.4 million barrels per day takeaway capacity. The question becomes how much of these need to get built in order to manage that differential in the absence of further production increases. And we're going to explore how much of that 3.4 has to be built to manage the differentials. What this table does is it's actually a split table. The top table shows you what happens when crude prices expand in $10 increments from $40 a barrel all the way to $100. That is in US dollars. The second column is currency exchange. You see the currency exchange rate moves with crude price. The third column we're showing you is what pipeline utilization number has to happen in order to deliver the median differential of $16 a barrel in all of those pricing scenarios. And so that delivers the fifth column, which is the net back in US dollars, the sixth column, which is the net back in Canadian dollars, and how much additional takeaway capacity you need in order to, again, maintain a $16 differential in a rising crude price environment. The bottom table is a continuation of that. The left is continuation of $40 to $100. You've got the takeaway capacity required, which is a carry forward of the previous column on the right-hand side. And we've lined up the variables. We've got the quota of 325,000 barrels a day, the rail of 120,000, phase one of the refiner of 80,000 barrels, and it shows you how much pipeline capacity you have to have in order to maintain that pipeline utilization required to maintain that $16 a barrel. So you can see that we have to build somewhere between 2% and 24% of the announced export pipelines just to manage the differential of $16 a barrel, and that is in the absence of production increases. So in closing, or you can see the takeaways again, but in closing, yeah, the three announcements combined are going to close the differential to its historical median, but it's not going to stay at that level if crude production increases or if WTI price goes up. Both of those scenarios are going to require pipelines to be built. So it's a Band-Aid or a stopgap measure today on the three announcements. It's not a fix. For this and much more information on why Alberta has historically remained oversupplied relative to the U.S. market, please visit our full research report at cnelect.com.